Good afternoon. This is Bakes, Kevin Baker. Welcome to Bakes Takes Podcast, my show. It's Sunday, October 24th. Hope you had a great week, a lot going on, and let's get right into it. As many of you know why I do this, my sons, Bobby and Jack, they're 24 and 23, and they were in undergraduate business programs, and they and their friends would fire questions at me. I've been in the investment world for 30 years, hedge funds, mutual funds, etc., and I have the scars to prove it. Went through the 87 crash, discovered I didn't know all that much, and I really went to school, literally, got my MBA, and figuratively read everything I could get my hands on, and found technical analysis, reading charts and volume and patterns, and I use that first. I do a lot of fundamental work, and I always have, but I go technicals first, fundamentals second, and I'm finding out that's fairly unique, and I think it's helpful, and I hope it's helpful to you, and you tell me, but that's what I'm hearing so far. I read the things maybe you don't want to or that you don't have the time for. The Journal, Barron's, The Economist, a number of newsletters. I listen to podcasts. I monitor what my Google alerts are bringing me with all of the themes and groups that I come up with and that you come up with as well. So I'm in the background doing all this work for you. Know that I eat home cooking. I don't have any conflicts. All I do is talk about what I want my sons to invest in and what I invest in. It's pretty straightforward. It's a great excuse for me to stay connected to my sons. I say that unflinchingly. Tell me what your pain points are, problems you'd like solved, topics I should cover. Thank you very much. And thank you especially Charlie, Justin, Murph from this Luddite for getting me up to speed as we go forward here. Here's my phone number, 610-331-4283. Text me. You want to keep me things anonymous, that's fine too. Tell me guests I should reach out to. Help me design the show. Looking forward to expanding to Bakes Takes Plus, and please stay tuned. This is an investment, but here's my disclaimer. This is an investment advice. Please conduct and share your own due diligence, and the more that happens, the more fun we have and the more money we make. Fan mail. Murph came back to me today over the past week and asked me about Ishares Global Clean Energy, ICLN. And I wasn't enthusiastic about it before, but I always like to go back with an unjaundiced eye and see what I see. And I know I see what I saw then is my sell discipline kicking in. And I'm telling you, folks, this is worth the price of admission for this show. The world wants to tell you about stocks to buy, but they forget the back half of getting out in an efficient, dispassionate way. I do it, and I teach this to you, and this is going to be very, very helpful. So the sell discipline. Here we are. And please go to the YouTube channel if you're listening, audibly on the podcast. But go to the YouTube channel because you can see the charts, and I think it's helpful. So I put down these arrows here, and the leftmost arrow is the first time ICLN closes below the 200-day moving average, 21.97. Then the 50-day comes down through the 200. About a month later, 22.58, and then recently the 200-day went down and 22.24. So. 22.18. So just without doing anything other than just reading the chart and knowing this history, you're out at 22.24. It started the year at 28. It stock's down 21%. So it's bounced to 23.52. But I basically got you out of dead money. With the sell discipline. So, that's what I see. And when I go through my 1,700 plus charts, I wouldn't stop on this way on the bullish side. And it isn't that bearish, but I'm just not bullish. So the next thing I do, and I encourage you all to do this, for ETFs, go to the fact sheet and look at the holdings, the top 10 holdings, and you see what drives this. And what I see here, Murph, and everybody else, is I see solar stocks, and I see wind stocks, and I don't see any uranium. And uranium is clean energy, and people are coming around to this, but all these lofty carbon and ESG targets that everybody has, solar and wind will not cut it. You have to have nuclear, and you have to have uranium, and it's just that simple. So I'm going to stick with North Shore Global Uranium Trust, URNM, and here's the exact opposite of what I see with ICLN, the clean energy ETF. We start the year at 42.90, and we go to 92.98. We double. We're up 116% year to date. So you can lose 21, or you can go up 116. And door number 2 is very appealing to me. So my take is, and I really want to stress this, I've been doing this, it seems like the last 3 or 4 weeks, let the market tell you where to do more research. And instead of coming in with a thesis that you try to shoehorn or force into the market, I want it to be sort of like jujitsu. I want you use the market forces to your benefit, and don't try to fight the market. Go with it and flow. And uranium is ESG, and I found this in the chart back in July last year. I couldn't pronounce half the names, and but we were right. And so we've got a big winner that we're letting run, and I encourage you to do the same and stay tuned for more. Next, Murph asked about SOX, SOXX, the Ishares semiconductor ETF. And again, I go to the chart like I always do and look at these arrows. You get a big down volume. That was a warning sign. It wasn't, dramatic or conclusive. But when the volume picks up on the downside, I go, something's wrong. And we're still respecting the 200-day moving average at 434.54, but it feels and looks tired to me. And that's just, one of these things that I've watched millions and millions of charts over the years, and this is starting to roll over in my view. And then I go to the fact sheet, like I always do, top holdings, and there's Intel. And I'm surprised because Intel is sort of a old tech stock, old economy, but it's still the number one component of this ETF, and it's 8% plus of the ETF. And the next chart is Intel, and Intel had a lousy week. It had a horrible earnings call, big miss. It gapped down, as you can see by these arrows, closed at 49 some odd, and down 11%. So the number one name took a hit, and the ETF didn't look as bad as this Intel chart certainly looks. So my take is we're going to have NVIDIA and AMD coming out with earnings reports, and they're going to tell us if there's enough to keep the bull going. I doubt it, but hold this winner for now. Watch that 200-day moving average, and I think you're okay for now after taking the Intel hit. And I forget who asked about this in the past. It might have been Charlie, it might have been Murph, but DraftKings. And this is one of the things, my selling points for my service going forward. You ask me something, I put it into my system, and I'll keep updating when I see interesting price action and technical patterns emerging. So here's DraftKings, and it's taking out the lows. And go look at these arrows again. 48.42, the 200-day, we closed below that. The 50-day slices through the 200 at 48.81, and at 48.75, you should have been gone. And that's 48.66 on average, and we're at 46.52 now. Yes, it drifted up to the 50s, 60s, but the down volume is 63% above normal. Earnings are coming in 14 days, and this chart is telling me that they're not going to be saying a lot of great things, which I'm surprised by, because I would have thought football season would be when they make it rain. And I think that everybody knows the DraftKings story. It's one of the most successful D-SPACs that's out there. It's very expensive. It's losing money. And I think that it's time for it to roll over. Something bad is going on in DraftKings, or at least there's not enough good to move the stock. So my take is this is still an avoid, and I'm happy to discuss further, either on the show or sidebar. You tell me how you want to go. Disney, I just, Cramer came out with this investment club and said, in essence, defending Disney. And I'm going to say Cramer's wrong. And I think you should sell Disney. There was a Wall Street report that said sell, and I believe the thesis was that the subscriber numbers are starting to wane for Disney Plus, and they kind of have to because the growth has just been meteoric. But what I do is I say, okay, you have the volume picking up on the down days. You do have the first 2/3 of the sell discipline kicking off, and Disney to me looks weak. And some might think that's un-American to go against Mickey Mouse. But I'm here to make money and have my sons make money, and Disney's not going to do it for you in my view. And so this is a good example for Bakes Takes Plus. I'm going to monitor your stocks, your ETFs. I'm also going to look for mine, but I'll alert you of buy and sell points. And what's going to happen is you're going to see over time. I'm not right all the time, but I'm right a lot. And I certainly have concrete conviction of how to let winners run and cut losses, and I don't think many people do, and especially younger people. No offense, but this boomer does it, and we're adding value, and I'd love to hear from you. Coinbase is another fan favorite, and this is perking up. This is from, I believe, 2 weeks ago. And I said 280.61, watch for a new high and watch for the volume picking up. And here are the arrows. And it was at 273 at the time. Yeah, it's okay, 273. And then here we are a week later, we're at 293 and we're starting the process. So this is a launch pad in my view. It is continuing. This makes thematic sense to me with the cover of Barron's talking about the Bitcoin going mainstream, and I kind of like this because this makes it so I almost don't care what crypto ends up reigning supreme. They're going to be trading everything. There's going to be an NFT exchange. So now, full disclosure, I don't own it. I haven't pulled the trigger. I haven't done the what I did in the past when I was investing for mutual funds and hedge funds. That the real nitty gritty fundamental work, calling everybody, the suppliers, the customers, competitors, the valuation analysis. I have not done that, but I encourage you to do that. And this Coinbase chart is promising, and I hope that's been helpful. Next, this is going to be great. GameStop. I said last week that the memes are over, they're all behind me, to paraphrase Pete Townsend and The Who. And Mike, I got some pretty nasty comments. People can get a little snippy out there, and more so. My skin is pretty thick, and I'll say it again. The hedge funds don't care about you. They are on GameStop, and they're probably doing it better than you are. And it's over. You caught a couple of them ridiculously short GameStop at $4 or $5. Congratulations, it was a great trade, but now everybody and his brother knows that page in the playbook, and it's going to take another 10 years before you find someone napping on being 100% short of a very cheap stock that finally catches some air. So let me see the chart, please, Mike. There we go. So GameStop, and I'm the one that said when it broke above 212, it was going to 360, and we got that. So I'm not a bear all the time, but this is rolling over. The 200-day is at 169.53. We're kind of sitting on it right now. I would get ready to sell a third. I've said before that I think HODL is bullshit, and this is going to roll over, and you're still going to hate me, and that's okay. I can handle this. So my take is the memes are over. They're all behind me. Part 2, and please stay tuned here, because I'll help you with the AMCs of the world and others to avoid this coming onslaught, in my opinion. Reporters of the week. This is from the Business Insider. This is Lina, Batarags, and the Evergrande crisis. 4 questions that explain why China's property market, which is twice as big as America's, and where 20% of homes are empty, matters. And that title kind of explains much of the story. I've got a link in the show notes. Please go there, and you can get your take about what's going on with Evergrande. But then here we are, 3 weeks later, and another reporter from Business Insider, Harry Robertson, says the Evergrande crisis is spreading. Here are other Chinese property developers that are in default or wobbling. Fantasia, Cynic, China Properties Group have failed to meet payments. And economists are worried that the contagion in the property sector could knock out a key engine of Chinese growth. So my take is I'm treating this again like COVID. I'm not panicking, but I'm not dismissing either. And Another question I always like to ask is this bullish or bearish? Can this be bullish or bearish, or is it neutral? And I'll say about this, it sounds like it can be neutral. It can't be bullish to have indebted property companies missing payments and having an overinflated real estate market come crashing down, which is what appears to be happening. And for my subscribers, in or near China, I would love to hear your perspective, and I think that would add value to all of us. So tell me what you're seeing out there. I'd really appreciate that. Charts and tweets of the week. Jim Bianco from Bianco Research, a very thoughtful guy, writes that nearly 50% of the hash rate of the Bitcoin blockchain pulled the plug, packed up, and relocated to another country in a few months, and no one noticed. And I agree with him. It shows an incredibly resilient system, and he believes, and I think I do, that it's contributing for Bitcoin going above 60,000 again. Look at this chart here. This is the rest of the world gathering what China spilled, and the U.S. being a huge part of this, where the crypto miners have taken up what China tried to ban. So it's pretty impressive that this cryptocurrency incurred the wrath of the Communist Party of China and weathered it as dramatically well as it has. And so a tip of the hat to him. Now I'm going to look at more charts this next week. I'm a little surprised that Bitcoin sort of looks like it's stalling out here. There was a lot of excitement over the futures Bitcoin ETF, and we might be selling the news here. So I'm a little surprised we didn't, take off new highs. Ethereum looks a little bit like it's stalling as well. So stay tuned. I'm going to do a lot more work, and I'll come back to you. I don't have any position there at this point in time. Newsletters of the week. Bear Traps Report. Larry McDonald and his team. Take a look at this price in copper. Copper is copper supplies at the LME, London Metals Exchange warehouse, are at 47-year lows. And full disclosure, I own COPX, the copper ETF. China's weakness might have contributed to the sell signal kicking in, so I own a little bit less of it now. But the bottom line, this is a classic squeeze. People are demanding delivery of copper. It's not on the shelves, and we're seeing this huge spike here that the exchange is doing what it normally does and changing the rules so that the market acts a little bit more efficiently. But as I agree with this commodity legend, copper could scream. The supply chain issues that we're all seeing out there leads to draining of inventories of a lot of commodities, and copper is sure on that list. So stay tuned. I might be getting back bigger into copper if the chart tells me to. It talks about nuclear sentiment shift. The Fukushima disaster in 2011 led Japan and Germany to close nuclear reactors, and so segue to 10 years later now. Uranium spot was $32 at the start of August. We're at 47. The prior peak is 137 back in 2007, which is why I point to sort of a five-bagger, just getting back to previous highs. Individual traders have come into the Sprott trust, asset management trust, the uranium trust. It's raised twice the amount of cash from shareholders that they thought they were going to. It's up 49% since the inception in July. And we know from Tim Rotolo and our interview with him, the head of URNM, that they're a significant holder in this as well. And most people don't realize this, but nuclear power provides 1/10 of the world's electricity, and it's going to send the uranium stocks even higher from here, in my view. So, and the CEO of the Sprott Trust is going to be talking with Larry at a conference next week, and that's probably going to kick up some dust as well. More on the commodity theme. We got 6 factors that are exacerbating inflation. No new mines. What happened when prices got crushed for oil, coal, uranium, copper, gas? people sat on their wallets, and $2.5 trillion from 2014 to 2020 was not invested because it was uneconomic. And meanwhile, the global population rose by 700 million people, and it's all coming home to roost. There's no new factories. Classic colossal underinvestment in things that consumers need, like cement, for example. The amazing increase in money supply in the federal debt. It's 3x the post-Lehman period, what we're going to see over the next 3 years. ESG is necessary, but perhaps ill-timed, and contributing to this. The supply chain is clearly inadequate, as you can see from the dozens of ships that are off Long Beach. And the demand shifts in China and India as their middle class expands. So everything is coming to commodities, and we were there because the market told us to go there. So we're 35% in cash. We're short the SPACs, and we're short, especially the EVs. We're short the emerging markets, especially China, and we're long agriculture, copper, and commodities. That's an unconventional portfolio, but it is working, and I encourage you to at least think about reassessing your portfolio and maybe incorporating some of my ideas. Folks, that's the show. Please also subscribe to my Bakes Takes YouTube channel. The audio is the same, but the charts that I reference are on the screen. Please follow us on Twitter at @BakesTakes_ and other social media. Please use your voice memo app. Tape your questions and email to bakes@bakestatepodcast.com, or write in if you prefer. I'll keep you anonymous if you like. Thank you for listening. Mike Wilson is my producer. Have a great week. And for much needed levity, this is Frank Caliendo. He does wonderful impressions, and here are 20 of his funniest and best. And I encourage you to go to the link in the show notes. And after we go through all this serious financial stuff, it helps me to get a couple laughs in, and I encourage you to do it. So keep smiling, and I'll see you next week. Bye now.